Welcome to another edition of the Wealth Nation podcast. I am Yolanda Harry Prasad. I am a wealth advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and to build generational wealth. Thanks for joining me today. And today we're going to be talking about the common investing mistakes that you shouldn't be making right now. Now, we know it's a time of high volatility, high inflation, possible recession. So today I hope to give you a couple of ideas on how you should be approaching your investments and mistakes that you should not be making. So you know beforehand. So please don't be making these mistakes. So it's been a pretty down year in a big way. And I know at times we can panic and we can do something rash, but this is just a quick review of these 4 investing mistakes that if you don't make them, it can help you move through a very tough market with minimal damage. So the first mistake that I don't want you to make is holding your money in cash or interest-bearing instruments. Now, since January, the S&P 500, it's something that I talk about a lot on social media, on the podcast. And now the S&P 500, it's an index of 500 big companies in the United States. Now this index is down 20%. So basically it means more investors are selling their shares versus buying. So you may be inclined to do the same. Personally, I'm not. Whatever money I can get my hands on, I'm buying things like the S&P and the NASDAQ and things. And you might be inclined to be selling. Because if you're a client, we have some exposure into the S&P and hiding out into more safer havens like money markets and bonds and things like that until risky indexes and shares return back to a growth phase. The thing is that making moves away from equity investments right now, especially if you're already in them, is not the most profitable thing for you to do. People do it mainly because it's easier on the emotions. Okay, you're telling yourself, at least I won't lose more if I move now. But unless you can predict when the markets are going to turn around, this is going to be a strategy that sets you up for far lower returns. Here's what happens. If you sell today, you get 20% less than you would have at the end of 2021. You then wait until you know the markets have recovered. And then what you do, you go back into the very same investment that you cashed out at a loss. So as these share prices and these index prices start rising again, that's when you want to buy and rebuild your portfolio. But that's when you've made such a big loss already. Now, if you stay invested, on the other hand, you keep your portfolio intact. No worrying about when to reinvest, no value loss on the liquidation or anything like that. You just have to brace yourself. Don't even, if it's too much for you, don't even look at your investments right now. I still check mine ever so often, and all those negatives, they're not happy. But if you were on the investor forum at the end of June, you'd know what's coming. You know when it's a steep dip like this, it's going to recover nicely in the next couple of months. The second mistake I don't want you to make is being fixed on these expectations. Now, whatever your expectation of your investment was 6 months from now, it has to change. It has to be more realistic to the situation. Novice investors, they often have this expectations around the timing of growth. And you might expect your investment to appreciate 10% a year, for example, or 50% in 5 years. Now, the more you are emotionally attached to those kind of expectations, the more panic sets in when a climate like this, an investment climate like this comes about, because the results will fall short. And then you start panicking and then you make some rash decisions. So avoid any kind of emotional attachment to any sort of a result for this year or even next year. You can project your portfolio growth for the medium term, 5 years, 10 years or more. Shorter durations are likely to depart from your plan, sometimes significantly. And I want you to be prepared for that as an investor. Now, investments are not predictable. And you gotta roll with the flow at times. Number 3 is you holding too few equity investment, high risk investments. Now, you can sometimes get away with not diversifying in a growing market. Now, in markets like this one, though, a lack of diversification can burn you. If most of your wealth is tied up with one company or one type of investments like bonds or indexes or money markets that is hit hard by inflation, your portfolio value will likely drop. So the number on the portfolio would stay the same, but remember, inflation is eating away at that money. So the buying power of that money is slowly dropping. If you hold equity investments across different economic sectors, alternatively, invest in indexes like the S&P, for example. That will spread your exposure across 500 different companies in the United States. Number 4 is doing what everybody else is doing. Now, Warren Buffett, the world's ultimate investor, right? He said that his goal was to be fearful when others are greedy and be greedy when others are fearful. He created vast amount of wealth by going against what popular opinion is. And now this makes sense. You take advantage of lower investment prices, lower unit prices in those investments. If you sell when others are buying, you benefit because the demand for buying is higher. The supply is slowly depleting. That means that drives prices up. So if you are holding these share prices or investment prices that are going up, you sell it at a profit. So it really boils down to buying low, selling high. It's the basic formula. Whether you're selling tomatoes, whether you're selling ETFs, unit trusts, it's the same thing. Buy low, sell high. Following the masses can result in opposites for you. You end up buying high and selling low. And that's definitely not the way to make money. Now, if you're diversified, the simplest way to sidestep these common investing mistakes right now is to do nothing at all. Just sit tight and wait it out. Don't sell off shares that haven't really deteriorated. Don't get attached to expected results, and don't make trading decisions based on what everybody else is doing. Sit tight. It's a tough time. Let it run its course. Keep your portfolio intact so you're positioned to reap the rewards of the recovery gains later. That's it for me on this edition of the Wealth Nation podcast. I'll talk to you next week.